FR lecture 25. So, in this lecture, we are going to go through consolidated statement of profit or loss. In my previous two lectures, that is lecture 23 and lecture 24, I have gone through the consolidated statement of financial position and consolidation adjustment. So, in this lecture, we will go through the control and ownership concept, working schedule, other comprehensive income. Then we are going to go through the intra-group transaction, why we have to eliminate them on consolidation, then the dividends, other items. Then we are moving on to the goodwill impairment. Goodwill impairment is an expense recorded in profit and loss. So how we are going to allocate that, and the mid-year acquisition, when you are acquiring a subsidiary in the mid-year, how do you account for it? How do you account for the fair value adjustments? Then profit or loss adjustments. Then when we dispose, the impact in separate financial statement versus consolidated statements, and discontinued operation. Then finally, we are going to conclude with the syllabus, summary, and technical articles. So this is an overview of what I've just discussed. In the profit and loss, we have intragroup, we have goodwill impairment, other adjustments, and disposal. So these are the four areas we are going to cover under the statement of profit and loss. Now, starting with your statement of profit and loss shows the income. Okay, basically it is an income that is generated by the resources that you have. So the parent's separate statement of profit and loss includes dividend income from their subsidiary. If parent is receiving any kind of dividend from their subsidiary, in the parent's separate financial statement, profit and loss, it will be shown as an income. But in the consolidated statement of profit and loss, that income is the group's income. Okay, it will be shown in the net asset in your consolidated statement of financial position. It will not be shown as an income in your profit and loss. So, your consolidated profit and loss is prepared on a basis that is consistent with your statement of financial position that you use to prepare your consolidated statement of financial position. Now, so here, when you control something means it's your subsidiary. Then only you can consolidate line by line. So same how you used to consolidate in your statement of financial position the assets, liability of the parent and the subsidiary. Here it is about revenue and expenses that you will consolidate. So revenue will take the parent and subsidiaries. Remember, subsidiary you can acquire any percent, 50%, 60%, 70%. But when you're taking the revenue, 100% of the revenue you will accumulate. Minus any intragroup transactions. Always eliminate. Then we are moving to the profit. Then this profit. These are the two important things. It will be allocated among the parent and the NCI. Okay. And then we'll have the profit for the period. Okay. Now, so this shows the profit and loss section of your statement of profit and loss and any other gain or losses for the period included in OCI. Okay. So profit and loss will go in profit and loss. Any gain, other gains or losses will go in OCI. Then profit or loss shows the income generated from the net assets under the parent's control. That ownership is reflected by allocating the profit between the NCI and the parent. Okay. So when you take the parent's profit, it is just the balancing figure. You will already have your profit for the period. So from there, NCI you have to work first, and parent is always the balancing figure. Then any intergroup transaction, eliminate, because intergroup means any transactions between the groups from parent to subsidiary or parent subsidiary to parent. Either way, eliminate. Now, working schedule. So your statement of profit and loss you will prepare using columns, where you will have the parent's results in one column, subsidiary result in the second, and some adjustment. And finally, the consolidated results. Consolidation adjustments will be made in the adjustment column. Okay. If they net off to zero, they will not affect your profit. So adjustments that do not affect the profit should be made in the relevant companies column as detailed throughout this lecture. This ensures allocation of profit to NCI by just simply applying NCI percentage to the total of the NCI column. Your consolidated amounts you will calculate by adding the parent plus the subsidiary adjustments, plus or minus. Now, this is that schedule we have been talking about. So you have parent, subsidiary adjustment and consolidated. You see revenue, cost of sales, you'll add unrealized profit, you will deduct. It will have an impact on the consolidated. Then what else? Dividend you will eliminate, and then you get profit for the year. Now, other comprehensive income. If the parent and the subsidiary have OCI, that is other comprehensive income, that working schedule have to be extended to include this OCI. They are added across parent plus subsidiary in the same way how you will add income and expense in the statement of profit and loss. Where there is other comprehensive income, the following should be allocated with the parent and the NCI. Same how you allocate profit for the year, even other comprehensive income, you have to allocate among the parent and the NCI. So profit and total. Remember, when you allocate your other comprehensive income with that other comprehensive income, this profit is already added. That's why it is total comprehensive income that you allocate, not the OCI. It is TCI that you allocate among the parent and the NCI. Now, intra-group transaction. What is the need for elimination? See, consolidation is going through a concept that means parent and subsidiary are one single entity. Okay, so if they trade among each other, it is like you are trading with yourself, not with outside. So sale of one goods will be matched with the purchase of good in another member. So this intragroup balance you will eliminate in both your financial position and also in profit and loss. Now, dividends. Dividends that are paid by subsidiary, they are an appropriation of profit, and parent will have to account for this dividend receipt as an income in their separate statement of profit and loss. But on consolidation, this dividend income is replaced by the subsidiary's profit. So dividend recognized in the parent separate account, you cannot include them in consolidation. Then it will be double counting. So therefore, what do you do? Eliminate dividend also on consolidation. Any dividend from subsidiary that is reported in the parent's separate statement of profit and loss have to be eliminated on consolidation. Therefore, in the consolidated statement, the only dividend income in your profit and loss is trade investments. It's from trade investment, not among members, not between subsidiary and parent. The only dividend payable in the statement of changes in equity are the parents and subsidiaries payable to NCI. Other items. First, trading. Any intra-group trading transaction will be included in revenue of one group and purchase of another. So what happens? If you are summing all the revenue and the purchases in preparing consolidated statement of profit and loss, it will overstate both from a group perspective. So since the group is a single entity, you cannot include any intergroup trading. This also eliminate. So add parent and subsidiaries revenue and cost of sales line by line and deduct any intragroup sales. This will not affect the profit. Therefore, there is no effect on the NCI share of profit also on this. Next item, unrealized profit in inventory. This is very much tested in almost all FR and SBR exam. This is when one company is selling an item to another entity. Both are members of the same group. Either parent is selling to subsidiary or subsidiary, and the good is remaining in the inventory. The good has not been sold to a third party. So that profit is unrealized. That means you are not selling that inventory outside the group. So you have to measure that inventory at the lower of cost and net realizable value to the group. Unrealized profit you will eliminate. How? Calculate that unrealized profit, deduct it from the inventory in your statement of financial position. We have done this in lecture 22. Then you have to add this amount to your cost of sales that sold the goods in the consolidated statement of profit and loss. Since this profit is not realized, it's an additional cost for them. That's why you will add it to the cost of sales. Example 1, where you're supposed to calculate group revenue, cost of sales, and gross profit of Whale and Propoise. So Whale is owning 75% of P. Now you have been given revenue, cost, and gross profit. P is making sales of 30 to Whale. Gross profit margin is 20. Of the sales, 15,000 is remaining in the inventory at the year end. So this is the solution for this, where we'll take the revenue 120 and 70. Okay, and then we'll deduct the intergroup sales, that is this 30,000. Who is making that sale? P is making. So from here we'll deduct in the adjustment. And once you take the total of this 120 plus 70 minus 30, it is 160. Then cost of sales, it is 80 and 50. From this cost of sales, you will add this 30. Remember, it's an addition. Then unrealized profit. Unrealized profit you have to find out, right? How do you get that unrealized profit? See, understand here P's sales means Well's purchase 30,000 eliminated in full. Then if you take gross profit margin is 20% on this 30, so 20% on 30 is 6,000. This is the profit that P is making. Okay, and half has not been realized to the group. Why half? See, they told 15,000 out of this 30. 15,000 remain in the inventory at the year, and that means out of this 30,000 sales means 15,000. Half, if you take percentage, is 50% remaining in the inventory. So your unrealized profit is also 50%. That is half of 6,000. So this 3,000 is your unrealized profit. Who has made that profit? P. So from P we'll deduct that 3,000 because he is the one who is making the sale. And then we get a gross profit. Here there will be nothing because this 30 and this 30 cancels out. Then NCI is 25% because you have acquired 75. Okay. So it is 25% of 17,000 because you only have to take piece. From here you have to take 25%, not the entire gross profit, not the consolidated gross profit. Right? So please understand these notes because in this case it is the subsidiary who is the seller. So unrealized profit adjustment is made in the subsidiaries column. So the calculation of profit allocated to NCI is based on the subsidiaries profit after you adjust for the unrealized profit. If the parent has been the seller, then that 3,000 would have been deducted from well. Okay. In that case, subsidiaries gross profit would be 20,000, not 70. Next, non-current asset transfer is the next item. So in your statement of profit and loss, you have to include depreciation, okay, based on the cost to the group, and exclude any profit and loss on that non-current asset transfer. between group members. See, when you're transferring any non-current asset transfer among the group, there is no profit and loss on that because you are part of the same group. So you exclude that profit and loss. This is consistent with your treatment in the profit and in the statement of financial position also. So any intra-group non-current asset transfer that takes place in the current financial period or an earlier period, where the transfer is taking in the current financial period adjustments, okay, adjustments will be made to the statement of profit and loss. 2. Eliminate any profit and loss on disposal and adjust the depreciation charge. If the transfer took place in an earlier period, only adjustment is to the depreciation charge. Okay. Now, adjustment to eliminate profit and loss is made in the selling companies column. The one is selling parent or the subsidiary. From there, you have to eliminate that profit or loss against the line item in which profit or loss was originally recorded. The adjustment to the depreciation is made in the buying companies column. The one is buying their asset against the depreciation record. This is an example of that. Parent is owing 80% of subsidiary. Parent is transferring non-current asset to subsidiary for 15,000. Original cost of asset is 20,000 to parent. Depreciation is 8,000. Useful life is 5 years. Useful life at the date of transfer is 3 years. Both companies include depreciation in general and admin. General and admin expenses 700. In the parent separate statement of profit and loss, 500,000 is there, and 500 in subsidiary separate statement of profit and loss. So the general admin expense for parent is 700, for subsidiary is 500. You have to show the adjustment required for the above transaction in the profit and loss for 31st December 2006. Now, here also parent, subsidiary, adjustment, consolidated. So, two things under general and admin expense and depreciation adjustment. So, in this we have two things, unrealized profit and depreciation adjustment. So, parent has 700, subsidiary is 500, together is 1.2 million. Right? Now, first let us finish with the unrealized profit. If you see, you are transferring it for 15, but original cost was more, 20. From this 20, the depreciation to the date was 8. So you will take the depreciation out and compare with 15, which is a profit. This 3,000 is to the parent. You have to adjust. Who is selling? Parent is transferring it to subsidiary. That's why parent is the one who is having this unrealized profit. And then depreciation, you will deduct. How much you're transferring? 15,000. What is the useful life at the end of transfer? 3 years. So 15 divided by 3 minus depreciation that have already been taken. What is it? So here it is 5,000. This is 5,000. And this depreciation is in the buying. It is transferred to subsidiary. So depreciation adjustment is in the subsidiaries column, ensuring NCA is allocated to the share of adjustment. How is this? 4,000. So it is simply this cost 20,000 divided by 5 years, because the useful life was 5 years, which is 4,000. So when you compare, the adjustment is now more. It should have been 5,000. but it was recorded as 4,000. That means 1,000 additional depreciation you have to deduct. When you do this, this is your consolidated figure. Now, moving on to the next item, interest and other charges. Where a group company is lending money to another group company, the loan asset is eliminated against the loan liability in the financial position. But due to that loan, one company will have an interest income, another company will have to pay interest expense. That is also eliminated in profit and loss. Many companies make management charges from parent to subsidiary, for example, for head office services. So the parents in the parent separate financial statement, they can recognize it as an in their profit and loss statement, they can recognize this as other operating income. And subsidiary, they will recognize it as an operating expense. But on consolidation, these management charges are eliminated. Example 3 of an intra-group loan. Parent is having an 8% 100,000 loan to subsidiary. In their separate financial statement, 8 of 100 is 8,000. They are recognizing it as an interest income. For subsidiary, it's an interest expense of 8,000. No issue, but in the consolidated, it is eliminated. This income and expense. So there is no interest income, there is no interest expense in the consolidated statement of financial statements. Now, third is goodwill impairment. How do you allocate? This is often tested in SBR as well as FR. Very important. So goodwill, we all know it is an asset. We test it annually for impairment, and impairment is an operating expense that goes in profit and loss. But that impairment loss, you have to recognize it, you have to allocate among the NCI and the parent. And it will only be allocated among NCI if NCI is measured at fair value. Otherwise, the entire amount will go to parent, which is known as full goodwill method. If you are measuring NCI using proportionate share of net asset, then any goodwill impairment will be borne by the parent only. This you need to remember. So in your consolidation working schedule, that is your working, you have to include the impairment loss in the parents column if NCI was measured at proportion method, and include a loss in the subsidiaries column if NCI was measured at fair value. This ensures NCI has allocated its share of loss. Now, a gain on bargain purchase. This I've covered in my previous lecture. What is gain on bargain purchase? When your goodwill is negative, that means you are paying less than the value of the net asset. So this is an income that will go in the operating category. Okay. So it doesn't matter how NCA is measured. Bargain purchase is always allocated to the owners of the parent. And so it should be included in the parents column of the working schedule. It will not go to NCI. NCI can be measured at fair value, NCI can be measured at proportional. Bargain purchase always to parent. Activity 1. So here Pathfinder is holding 75% of Sultan. Okay. We have been given the revenue till the profit. Pathfinder is selling good to Sultan for 20,000. Gross profit margin is 40. Half of them is remaining at the year end. NCI is at fair value. Goodwill is impaired at 3,000. So now you know NCI is at fair value means this goodwill impairment 3,000 will allocate among the NCI and the parent. And unrealized profit will be half of what is sold. If you take 40% of this is your profit and half of it is your unrealized profit that you will eliminate. So these are the two major transactions. You are supposed to prepare consolidated statement of profit and loss. So now let us do this on Excel. So now let us start preparing the line item one by one, starting with the revenue. So the revenue, then we have cost of sales, then we have the gross profit, Then we have the operating expenses. Then we have the goodwill impairment loss. Remember, before our operating profit, we deduct goodwill impairment loss. That is under operating expenses. You have to clearly mention it is not there in the original profit and loss. Then we have operating profit. Then we have profit before financing and income taxes. The reason why I highlighted it in red is because it's a new thing added here. It's not here. We'll not see it here. So profit before financing and income taxes. And then income tax expense. Then profit for the year. So till here we have, and next one is profit. This is new. You have to allocate this profit. There is no OCI, only profit. Profit allocated to owners of the parent, or you can simply say parent, and NCI. For NCI there is a separate working 3. Okay. So now let us start with the revenue. If you see the revenue, it's 150. So plus 100 plus 50, then you will minus intergroup sales, which is 20,000, 130,000. Coming to cost of sales, here 60 plus 30 plus this 20,000 you will add in your cost of sales. So remember, when you're taking your cost of sales, with this you have to adjust the unrealized profit also. So let us go to the working. Working 1 is basically your group structure that says Pathfinder has acquired 75. So I will not show it here. And 2 is simply your consolidation adjustment. So I'm not going through the working 2 because I'm straight away putting the figures here and showing you. Working 3 is about NCI. And working 4 is unrealized profit. You can say URP. So it is first the selling price, the cost, and the gross profit. So if your selling price is 100, you have sold it for 20. So this is in terms of percentage, and this is in terms of the value. Okay, your gross profit margin is 40%. That means this is 40, so cost would be 60%, right? Now when you're taking 60% of this is 12,000. So your cost is 12,000. Then it is simply this minus this. If you want to find in terms of value, your gross profit is 8,000 and half of them is remaining in the inventory. This divided by 2. So 4,000 is your unrealized profit. Okay. So that 4,000 you have to adjust here. Remember, when you're taking this a minus figure, and plus 4,000 minus 4,000 is minus. Okay, unrealized profit you have to deduct. Now gross profit does not need any working, just the sum function of this two. That's it. And then we have operating expenses, which is 20 and 10, so minus 30,000. And then we have goodwill impairment already given as 3,000. And operating profit is the sum function. It's 23. And then we have profit before financing and income tax as 20. Is the same. Then income tax is 3 and 2, so 5,000. Again the sum function to get profit for the year, which is 18,000. Now when you allocate, first we'll go to NCI working number 3. Okay. So this is why you need the consolidation schedule to know the amount of profit for Sultan, for the subsidiary. Because here you have to find the NCI. Why goodwill impairment will go to NCI? Because NCI was considered at fair value. Okay. So now let us go here working to consolidation schedule. Okay. So we'll only find Sultan. So we'll just take all this figure. So Sultan's revenue is 50,000. Then his cost of sales is 30,000. Then his operating expenses is 10,000. Then goodwill is 3,000. And income tax is 2,000. And then comes the profit. So our income tax is here, just 2,000. And then let's perform the sum function to get the profit, which is 5,000. So it is simply this. Okay, if you just take Sultan's profit, it's 8. You just need to deduct the impairment of 3 and you'll be getting 5,000. That's it. So here it would be this profit into 25% NCS percentage. So this is NCI 1 to 50. So here it's 1 to 50. If you see here, this is the profit allocated to NCI. Okay, so if you want to get for the parent, it is simply, it's the balancing figure, this minus this, that's it. So this is the solution for activity 1, where we have worked out on the impairment loss and NCI, and this is the balancing figure which we have got out of this, right? So this is your group 1, that is mostly the group structure, that P have acquired 75% of S. Then we have the schedule, the parent subsidiary adjustment consolidated. Okay, so here 20,000 sales we have eliminated, and also we have added in cost of sales. Then unrealized profit we have worked out in 4. We have deducted it from Pathfinder because he's the one who has sold it. So it's unrealized profit for P. And this 3,000 will be taken in the subsidiaries fully because NCI was measured at fair value. So we need this 5,000 profit figure of the subsidiary later on. So moving to 3, when we want to find out the NCI, we have taken that profit of Sultan and taken 25% and got this. Then 4, how did we get unrealized profit? The selling prices, gross profit margin is 40. So if you take 40% of this 20,000, straight away you will get 8,000, and half of them is remaining in the inventory. So half of 8 is 4,000. Or you can go in this method, percentage and value. So in percentage, gross profit is 40 means cost is 60, and when 20,000 at 60, this is the cost, and 8,000 is a long method. You can straight away get shortcut also by just taking 40% of 20,000 and divided by 2. Now moving on to mid-year accusation. Consolidated financial statements only include results of subsidiary from the date of accusation. If the subsidiary is acquired in the mid-year, you have to proportionate your results in the statement of profit and loss. But in your financial statement of financial position, no need to prorate. You will take the entire figure. Only in profit and loss. Okay. So you will include the results from the date of accusation. Okay. Line by line, you will add the revenue and expenses, assuming they are occurring evenly over the year. So you have to time apportion your revenue and cost. So in your profit and loss, post-accusation portion, this you have to adjust for any intra-group items. What about pre-accusation? The pre-accusation portion, the portion before you have acquired, this will be included in the subsidiaries' retained earnings as of the date of accusation. And therefore, it is relevant to your goodwill calculation. Okay. So you can see lecture 23 already for that. Now, transactions in your profit and loss are acquiring evenly over the time. So you don't have to worry about it. Activity 2. Here you have been given the revenue, cost of sales and gross profit of both the parent and the subsidiary. Parent is acquiring 75% of subsidiary on 1st April. Year end is 31st December. So you see the result is for 9 months. You have to prorate everything. Parent is making sales to subsidiary for 15,000. Is an intra-group sales you have to eliminate. None of those goods remain in the inventory. That means no unrealized profit. Calculate revenue, cost of sales and gross profit. So just take 9 months. Okay. You take the parent, it is 100, cost of sales is 70, and gross profit is 30. Parent, there is no adjustment. Coming to subsidiary, you have to make that 9 months for subsidiary onwards. This. So 75, you will take 9 months, it is this. Then 60, 9 months is this. And this you have to deduct intergroup sales. In the revenue and cost of sales, you add. So this is your total consolidated figure. Now, next, fair value adjustments. As previously explained, fair value adjustment you have to account for on acquisition to recognize goodwill is acquired at its fair value and subsequently at each reporting date as long as the difference remains. Any movement in your fair value recognized in your statement of financial position between the reporting date, you must affect your statement of profit and loss. For example, if there's an excess depreciation on your non-current asset, see example 4 in ledger 23, or amortization of your intangible asset that was recognized in your cost of sales, selling expense, research and development expense, or general and admin expense. Then, when there is a fair value uplift on inventory sold during the year, you can see example 6 in lecture 23. This will increase your cost of sales also. And any NCI that will be allocated its share of the adjustments because it relates to the subsidiary. Example 4. So you have to calculate the profit to NCI. Here, Pronto is acquiring 90% of Swift. The fair value exercise is there. Except these two exceptions, fair value is equal to carrying amount. So you have to adjust your fair value for this. Your warehouse had a fair value of 500 above the carrying amount. Remaining life is 20 years. That means you have to depreciate. Then inventory is 300, fair value is 425. This also you have to increase. Now the following asset and liability that are not recognized in the Swift's financial statement. Their in-house research and development has a fair value of 200. Useful life is 4 years. And contingent liability, fair value is 250. Claim was settled. Their profit was 1 million. So now let us do this. See, when you adjust, you have to adjust from the question given. You have been given 1 million profit. Now you will adjust back. So one by one. First, let us start with this. That's the first. Number 1, number 2, number 3, number 4. Like this you will go. How many adjustments are there? 1, 2, 3, and 4. In that order. So if you see here, from your profit, if your fair value increases, depreciation will be more. So that depreciation you will deduct. Fair value was 500,000 more than the carrying amount. So 0.5 million over 20 years. That's your excess depreciation that you will deduct. Then adjustment to the cost of sales. This is also more. 425 versus 300. 125 you have to deduct. So the amortization of R&D. This you have to deduct, same like depreciation. So the fair value is 200, useful life is 4 years, which is 0.2 million divided by 4. Then contingent liability you deduct, but when you reverse the contingent liability, you have to add it, right? So which is 250. They have already given you the estimated value. And once you get it, then this is your corrected profit. On this, you have to take the NCI percentage, which is 10% because you have acquired 90%. So this is your NCI. Okay. Now, profit or loss adjustment. So from fair value, we are moving on to profit or loss adjustments. We have accusation related cost. An accusation may incur some cost. It could be legal, advisory, valuation, or professional or consulting fees. This cost, you do not include them in your cost of investment. Rather, they are expensed, which goes in a statement of profit and loss under operating category. Okay, so you have to remember whenever you are given this cost, they are not part of cost of investment, rather, they are expenses. Then we have deferred consideration. Deferred consideration you will include in your calculation of goodwill and you will recognize it as a liability of the parent at the date of acquisition. We have covered deferred consideration in detail in lecture 23. Next, we have once again deferred. So because it's a liability, you have to increase this amount over time by unwinding the discount. So at each reporting date, this liability will increase by that interest. Okay, you have to use the same discount rate that you have used to find the present value. So that using that discount, you will be getting the interest rate. Okay, if the parent has not recorded this in their separate financial statements, adjustment has to be made when you're preparing the consolidated financial statement. So you debit your interest and you credit liability. And your liability is increasing as it approaches the actual payment date. Now, next, contingent cash consideration. If the contingent consideration is settled in cash, you have to remeasure at each reporting date the liability and the changes will be recognized in profit and loss. Same like deferred consideration. As before, the contingent consideration is a liability of the parent if it was not recognized. Okay, the remeasurement in its separate financial statement. Then you have to make the adjustment while preparing consolidated statements. Then we are moving on to section 5, which is disposal of subsidiary. When you dispose the subsidiary, okay, this disposal you have to reflect in the parent separate financial statements as well as consolidated statements. Only the disposal of an entire investment, that is full disposal, will be asked in FR, but in SBR it is partial disposal. Now, first we'll go through separate financial statements. A parent presents their investment in subsidiary as a non-current asset investment. That's why under your non-current asset you will see an investment. That is this investment in subsidiary only. Okay, it is recorded as per IS 27 at cost or as per IFRS 9 using equity method. When you dispose the subsidiary, investment is derecognized and the parent's profit or loss on that disposal you will recognize in the investing category in your profit and loss. Why investing category? Because normally when we dispose subsidiary, we have subsidiary for an investing purpose. We do not use it for operating purpose. It's not our everyday revenue that we keep on buying or selling subsidiary. So investing. Then any profit and loss is calculated as proceed minus the carrying amount of the investment sold. This is the pro forma. And an accrual may be required for tax on that gain on disposal. So to record the disposal, debit your cash because you'll be receiving cash or receivable if you have not received in cash yet. Then credit the investment in subsidiary. Then if it's a loss, you debit. If it's a profit, you credit. And if relevant, if there's a tax expense, normally they do not ask the tax part. But if they ask, if there's a gain, you will debit it, the tax expense. And if it's loss, tax payable credit. So you debit tax expense, sorry, you credit the tax payable because it's a liability on you to pay that tax. Now, a disposal of subsidiary in your FR exam will not include this tax calculation. Okay, so you don't have to worry about it. Then consolidated. First, we'll go through financial position. If parent is selling all of their shares in that subsidiary, subsidiary will not be presented in that consolidated statement of financial position, even if it is sold on the last day of the year. If the parent has not accounted for this disposal in their separate statements, profit and loss from the point of parent you have to calculate. Okay, and this amount will increase or decrease the consolidated retained earnings. So proceed minus cost of investment, profit or loss. In most jurisdictions, this amount of the profit will be taxable. Now, profit and loss, consolidated profit and loss. So here you have to calculate income and expense of that subsidiary, okay, till the date of disposal, and recognize a group profit or loss on disposal. So the group profit and loss will go in the operating category, not investing. Why? Because the consolidated subsidiary is not an investment of the group, rather it's a part of operation. And when you're disposing fully, the subsidiary's profit and loss will be consolidated up to the date of disposal, and any NCI will be allocated their share of profit and loss to the date of disposal. Now example 5. Here paper is purchasing 60% of shares in Scissor, and on 30th September they are selling all the shares. They have a year end 31st December. So their revenue and cost. Revenue is 60, cost is 42. Now this is how they will allocate. For how many months? See, from January, their year end is December. So that means 1st of Jan to 30th September, only for 9 months. They will calculate the revenue, only for 9 months they will take the cost and get the profit. And on that profit, since they have acquired only 60, you only have to take 40%, that will go to NCI. 40% of 13,500 is 5,400. Okay. Now, next, the group profit and loss is the difference between your sale proceed and carrying amount of the subsidiary. This is the pro forma. So you take the proceed minus the carrying amount at the date control is lost. You take your net asset, you take your goodwill also, and you deduct NCI. And then the difference between that with the proceed is your profit or loss. This profit or loss is different from the parent separate financial statements profit or loss because the carrying amounts are different. Example 6. You have to calculate gain or loss when they dispose of subsidiary in the individual financial statements and also in the consolidated statements. So here they have disposed for 100,000 cash. They have acquired 75% for 70. Goodwill was 20. Goodwill was impaired by 40. Net asset was 85. NCI was 20. Everything is given. You just have to put it. So first let us calculate the individual. Individual, it is the sale proceed. That is, how much did you sell it for? 100,000 cash. How much did you? What is the carrying amount? So 100,000 is your sale proceed. And cost of investment. It is simply the 70,000 because you have acquired at that. So straight away 30,000. See, individual profit and loss is very easy, straightforward. Difficulty comes in consolidated. Not difficult, but it has more steps. Here also sale proceed is 100 only, same. Difference is in the cost of investment. Carrying amount changes. So here, whenever you go in the consolidated, these things you have to take. Net asset, goodwill, NCI. Do not forget these three things. So net asset, they have already given 85. Okay, this one. NCI, they have given 20. Goodwill, they have given 20. They have told impaired 40%. So you have to deduct that 40% from 20. That means 60% of 20 you have to take, which is 12,000. And NCI you deduct. Okay, not the addition of 3. Then the difference between those two is your profit. You see, profit is much lower than the individual profit. Now, example 7. Plumper is purchasing 80% in system for 125. NCI was 30. Net asset was 140. Goodwill is 15. They have made a profit of 20. Goodwill is impaired by 4. Now, they are selling all of their shares for 160. This is how they have calculated the group profit. Okay. So how much did they sell it for? 160. 160. Then cost of investment, which is 125 because they have bought it for 125. This is their profit. This is in the parent separate financial statement. So this profit is included in the investing category and tax will be applied. Now, let us find the group. Okay, the group's profit will go in the operating category, remember. So how do we start? Same proceed 160, but carrying amount, three things will be there. Net asset, goodwill, NCI. Okay, now let us go to net asset. So net asset they told is 140. But with that 140, you have to see whether there are any changes or not. Okay, with that net asset, this profit will come 20. You have to add. So that 20 they have added. Next, goodwill. Goodwill was 15, impairment was 4. And NCI. NCI fair value was 30. But when you are taking, remember from this profit, you have to deduct this impairment 4 and then take the NCI percentage. You have acquired 80 means NCI is 20%. So 20 minus 4. With that 30 is your NCI. Then you get your profit. This is very simple. Now, difference in the profit. If you see the profit of the two figure, 22.2 minus 35. Okay. So, the 12.8 million difference in the two profit figure. What is your post acquisition profit? 20. What is goodwill impairment? 4. If you deduct the 2 and just take the 80%, that means plumber's percentage 12.8. But the group profit is 22.2. This difference exists because in the consolidated statement of profit and loss, plumber's share of the system's profit, that is the subsidiary's profit, less the goodwill impairment, while plumber's separate statement of profit and loss only includes the dividend that they have received from system. So higher profit is recognized in the consolidated statement of profit and loss during their period of ownership. Understand? Now, example 8. So as for example 7, except this time NCA is measured at proportionate method. Goodwill is now 13 million. Okay, everything proceed is 160 same. Net asset is also same. Now it's 13. Impairment remains 4. NCI this time they have given 28, and this is the profit. Remember, this time we do not deduct the impairment for. Why? NCI is measured at proportionate method. So no impairment goes to NCI, everything goes to parent. So just the profit 20 into 20 and you get the profit. Okay, so if you see the group profit before was 35, now is 23. The difference is 12. So this 12 million difference is because you see, if you take the parent share 80% of 20 million profit and then deduct the impairment is 12. That 12 was not included here in the proportionate method of NCA. That's why that difference. Now, next, discontinued operation. It is highly likely that when you dispose the subsidiary, it could be classified as discontinued operation. We have a standard for it, IFRS 5. That says any profit and loss to the date of disposal and any profit and loss on actual disposal has to be presented as a single line in your profit and loss. And then you have to further analyze and see whether there are any profit and loss that goes for discontinued operation. So you can refer back to exhibit 1 in your lecture 12 for the pro forma presentation. So because when a subsidiary is discontinued, their profit and loss is shown separately from other subsidiary, which is continuing. So as shown in the pro forma, you will analyze the profit and loss between continuing and discontinuing operation. Now, so now let us go through example 9. This is an example of discontinued operation where Alberto is owning 80% in Angus and 75% in debit. So if you look at the percentages, both are subsidiary. Okay, you have been given the profit and loss of both the subsidiary with the parent. Okay, then these are some additional information, and you are asked to prepare the consolidated statement of profit and loss. So Alberto is selling all of their shares in debit for consideration, and the gain on disposal is reported in their separate statement of profit and loss. When Alberto have acquired the shares in debit, their fair value of net asset was 28, same as their carrying amount. Alberto is measuring NCI using fair value, and fair value is 8. Income and expense of debit are acquiring across the year, and their equity balance is 38.5. Goodwill in debit is never impaired. Goodwill on acquisition was 17, was impaired by 20%. During the year, Angus has sold good to Alberto for 3.2. You see, it's an intra-group transaction, needs to be eliminated, making a profit of 1.4. 30% of these goods are still there at the year end. Okay, so if you see, it is very clear that David, the second subsidiary, we have sold it, and since you have sold it entirely, it represents a discontinued operation. So the group share of their profit and loss you have to show separately from Alberto and Angus result. Now we will be doing this on Excel. So how do you start this question? What is your starting place? Your starting place has to be with revenue, because that is the first thing presented to you. You always start by presenting the main profit and loss statement, and then comes your working number 1, 2, 3, 4, like that. So you see here, they have started with revenue. So we'll also start our consolidated statement with revenue. So we have revenue, cost of sales, gross profit, operating expense, profit, investment income, profit, interest, income tax, profit, all those things we'll have. And with this, we'll be having the additional stuff that arises out of consolidation, right? So we'll start here with revenue. So the first one item is revenue. Then we have cost of sales. Then we have a gross profit. Then we have operating expenses. Then we have goodwill impairment. See, there was a goodwill impairment. This was not there in the original question, but in your consolidated statement, you'll be writing goodwill impairment. So I will write it in red. Goodwill impairment. This needs a working, so I will show it in my working number 1. Okay. Then operating profit. So goodwill impairment, I will always deduct before my operating profit and after operating expenses. Then comes my investment income. Okay. So see here whether we have an investment income. Yes, after operating profit, investment income. Then profit before financing and income taxes. So profit before financing and income taxes. So I will write profit before interest and tax. Okay. Then my interest expense. Then profit before income tax. Profit before interest. Sorry, profit before income tax. I'm sorry. It's not interest, it's income tax. Then income tax. Then we have profit from continuing operation. This is what you have to write. This is how you separate when you have a subsidiary that you have disposed entirely. You have to write this word continuing operations. Okay. CONTINUING. Continuing. And then profit from discontinued operations. Then we have profit. Now this profit you have to attribute among the parent and the NCI. This section is new. So it is attributable to owners of the parent. So when you attribute to the owners of the parent, remember two things you have to attribute: profit from continuing versus profit from discontinuing operation. I will just copy paste here. Okay. And profit for the year attributable to owners of the parent. Okay, I'm just writing the short form. Then we have NCI, non-controlling interest. NCI. So NCI also just three things: from continuing, discontinuing, and profit that goes to NCI. Then we have profit for the year. Okay. Now after this we'll be going to workings. You see, now we'll start with the workings. So first working is your consolidation schedule. Okay. What consolidation schedule for Alberto and Angus, not David, because David you have sold entirely. So first working is working number one, consolidation schedule. A, Alberto and Angus. When there are more than one subsidiary, you have to label like this. Which subsidiary are you mentioning? Very important. So now we'll be having the four separate columns. We have for Alberto, then Angus, then adjustment, and then the consolidated. Okay. Now So here we'll be having all that, starting with this. This section I will just copy paste here. So you do not waste time to write all this. Okay. We need the revenue, the cost of sales, then the operating expenses, the goodwill impairment, investment, then there is a gain on disposal, and interest income, income tax, right? So before we go to working number 2, we can finish off with working number 1. So let's start with the revenue. If you see the revenue here, the parent, it is 18,450. Then cost of sales 9,430. Then we have the operating expenses 3,170. Then investment income 1,100. Gain on disposal 11,500. 660 and 1,340. So parent as it is, you can write it is 18,450. Then cost of sales minus 9,430. So we do not need the gross profit here. Then comes the operating expenses minus 3,170. There is no adjustment for the parent. Even the goodwill is for the subsidiary. So investment income, we do not net this also, is 1,100, 11,500 minus 660, the interest and income tax. So we do not net this as well. So for the adjustment, we'll be going through the additional information. Okay. So in the additional information, we have an intergroup sales that has been made, which is note number 6, 3.2. So Angas have sold it to Alberto. Okay. 3. So this is an intragroup which needs to be eliminated here, minus 3,200. Okay. Then this 3,200 you will add in your cost of sales. And here the cost of sales is 6,120 minus 6,120 as per question. Done. Then comes your operating expense. Okay, if you see the cost of sales, it is 6,120. Okay. Now so now you have to make an adjustment for URP, that is your unrealized profit. Okay, that unrealized profit you'll be deducting from your cost of sales here. Now, so now let us find the sum function and get the consolidated figure. And here, see here when you're doing it, here you have to make another adjustment. That is your unrealized profit. That unrealized profit will be doing in working number 2. So for timing, we'll keep it like this. Okay, we'll later come and adjust it. Now let us go to the operating expenses of Angus, which is 1820. So there is no adjustment, it's 1820 only. And then this. Then we'll be moving on to goodwill impairment. Goodwill impairment will be done in working number 1. Okay. So goodwill impairment will go to goodwill. They have already given you the impairment. They told goodwill was 17, it was impaired by 20%. So here itself we can do the work. 20% of that 17 is your goodwill impairment that you will deduct from here. So when you take 17 into 20%, okay, 17 million means you are taking 17,000, dropping the 3 zeros. So it is 3,400 is the goodwill impairment. It's a minus figure. Okay, so this will be, I will just drag it. This goodwill impairment will only be shown in the subsidiary, not in the parents. Okay, now moving on to investment income. Investment income is only for the parent. There is no investment income for subsidiary. Same for gain on disposal also. But this gain on disposal, since it was there only for the parent, on consolidation you have to eliminate. So minus 11,500. Done. Then interest expense. Here it is 315 and income tax is 930. So minus 315 minus 930. There are no other adjustment. That's it. Now, what's left is only one thing, that is unrealized profit, that has to be adjusted here in the cost of sales of Angus. That will do in working number 2. So let us go to working number 2. Unrealized profit. You can just simply write URP. So if you see here, they told in note number 6 they are making a profit of 1.4 million, 30% is still hold. So unrealized is 30% of that 1.4. That means 1,400 into 30% is your unrealized profit, 420. So this 420 you have to deduct from where? From here. Okay. Deduct means you'll be minusing it. Sorry. So automatically this consolidated is adjusted. You see, you will go and deduct from here in the cost of sales. That's it. Now let us go to working number 3. Working number 3 is NCI. So NCI, this is the profit part, right? Profit that is allocated to NCI. So first, see how much did you acquire Angus. You have acquired it at 80%, right? And if you see the profit, what is the profit of Angus? From here you have to see. Okay, this you will go get in your working number 1. Attributable to NCI. So just take the sum function and get the profit. Just take the total. It's 125,000. If you see, this 125,000 is a loss. It's minus 125. So when you're taking, it is 20% of that. Since you have acquired 80% of fungus, it's 125 minus 125,000. Sorry, it's already 1,000 is just this figure minus 25. Now parent attributable to parent, the balancing figure. So how are you going to get the balancing figure? Just get the sum function here. See this, if you want to get, right, you have to get your profit, that is here. You have to reach here. Once you reach here only, you will be able to get your amount that goes to parent, this one. Without that, you will not be able to do it now. So just keep it here, and then we'll move on to working number 4. Profit from discontinued operation. Okay. Here also we have profit for period and profit on disposal. So for this we have a separate working 5. So the profit for the period, this is for discontinued operation. Okay, so here if you see, we have 2 million profit, but you have to see for how many months. Okay, year end is 31st. You have to look at the dates. They have sold all the shares on 1st October. So that means from Jan to September, for 9 months they have been a subsidiary. So you have to take 9 months of this 2 million, that is 2,000. So this is the profit for the period from discontinued, that is from debit. And then profit on disposal, you have to add from your working number 5. Okay, now so let us go to working number 5. Profit on disposal. When you dispose David, what is the profit? So what is your consideration of proceed that you have received? You have disposed it for, let us go to the notes. You have disposed it for 36.5, the first note. 36.5 billion, so 36,500. Then the carrying amount. Remember, this is the group disposal we are finding out. So there are 3 things that you need: goodwill, net asset, NCI. So we have goodwill, net assets, and your NCI. But there is one more thing that you have to include in your net asset. That is the profit to disposal. That means the profit for the period. This 1,500, you will be adding it with your net asset in your statement of financial position. That's why you are getting it inside the carrying amount. Remember, with the proceed, you take the closing carrying amount. So in that net asset, you will be having the profit to disposal also. So profit as per working number 4, it is 1500. Then for goodwill, there is a working 6, because you need the closing goodwill amount after the impairment and all. The amount of goodwill that you have been given is the opening goodwill. Then net asset value has been given as 38.5. Okay, they told the company's equity balance is 38.5. Equity means that is the only thing under the net asset. So 38.5. Note number 4. 38,500. Now, okay, so the cell right here. Now, what's next? NCI. NCI I'll be getting through working number 7. This NCI is for the profit portion. This NCI is different. And then I will get my profit on disposal. Okay. Then I'll be moving on to my working number 6. So working 6 is goodwill. This is the goodwill on acquisition. When you have acquired debit. So what is the cost? Unit cost, NCI and net asset. Cost, NCI and net assets. So what is the cost? How much did you acquire it for? See, here you have to do an adjustment. You have to be a little smart enough. You have acquired it for. You see here, 36.5. So you have sold all of the shares for the consideration of 36.5. Okay. So from this consideration that you have sold, the profit, the parent's profit on disposal, you have to adjust. That is your cost. You understand? So 36.5 is the cost and 11.5 million. We have just got that 11.5 million. This you have to adjust. You have to deduct from cost when you're calculating goodwill. Okay, so it is 36,500 minus 11,500. This is the cost, 25,000. Okay, then comes NCI. NCI, they have given you the fair value 8 million. Okay, and net asset they have given 28. So this is 8,000 and this is minus 28,000. Get the sum function. And this is your goodwill. And then comes working 7, the last working. I know this is a little bit a lengthy question, and in your FR exam you will not get this lengthy question, but understanding is the key. This is NCI at disposal date, not accusation. So first at accusation, you have to take this 8,000 and then share of profits. So what is the share of profits? If you look at the share of profits, you have taken debit at 75%. So 25% is the NCI in the bracket. Now, if you look at the share of profit of debit, see, it is 38,500. Okay, how 38,500? Because they told income and expenses are quite evenly and the company's equity balance is 38.5. That means the net asset on this date. Okay, with this 38.5, you'll be adding the profit for the year that we have got here in working number 4, 1,500. And then the profit on disposal, the amount they have given, minus the net asset that they have given, which is at accusation 28. Okay, so you have to deduct the change in the net asset is your profit. You understand? So when you're taking here, it is 25% off your net asset at the date of accusation 38,500. With this, you'll be adding this year's profit 1,500 minus 28,000, the net asset at accusation, because that is your post accusation profit. So the sum of this two is your NCI. So now I have finished all my workings. Now what else is remaining? I have to go to my back to my consolidation and finish this off. So when I take my revenue, I have to take this. That's it. And then when I take my cost of sales, I should be taking this. That's it. And then using some function, I'll be getting my gross profit. And then my operating expenses is simply equal to this. And then my goodwill impairment is this. And then I shall be able to get my profit. Let's take this. And then investment income is this. Just put equal sign and press the cell. And then interest expense is equal to this. And then I have to perform a sum function to get the total, from my operating profit. And then I'll be taking my income tax, which is this. And then sum function 4825. Right? Now, profit from continuing operation. What about discontinued operation? This I will get from my working number 4. So I have to go back to my working number 4 here. This I will get from here. Working number 5. By the way, this I have not finished because once I finished my working 7, I did not refer back to my working number 5. This is useful. Why? Because I've labeled here clearly which working am I referring to. This is where referencing helps you. So always make sure that you correctly label which working you are referring to. So here NCI is 11,000, right? So you should be showing it 11,000. It's minus 11,000. And then the sum function of this 3 and this minus this is the profit on disposal, which is 7,500. But this is incorrect because one thing is missing here. What is it? Goodwill. I forgot to take my goodwill, which I'll get in my working number 6, which is 5,000 here. So equal to 5,000. Once I take this, it is simply this. That's it. So this is my profit on disposal, which I have to take in my working number 4, 2,500. And the total profit is 4,000. So this 4,000 is from profit from discontinuing operation, which I have to take here. That's it. Now, what else is remaining? The total. The total of this two is this 8825. So now this we have got in working number 3 and working number 4. Profit from continuing and profit from discontinuing. That goes to the parent and then NCI. Remember, these are the balancing figure. Same for NCI also. W3 and W4. So let us go to working number 3. Now I know what is my profit. 4825. So now I can distribute among the two. Okay. So now when I go to my working number 3, what is my profit from continuing? 4825. So this is the balancing figure. This minus this figure. 4850. So 4850 is for the parent that I will write here. Okay. So profit from continuing operation to the parent is 4850. Remember, there's a loss, and from continuing this is minus 25 in working number 3. Then from discontinuing we have to go to working number 4, which is this 4,000. Okay. So 4,000 also straight away we can't do. You have to look at your total profit. This is your profit, 8825. So your profit for the year has to be 8825. Okay. Out of this, so let us go to working number 4 once again. You see, the profit is 4,000. Now, if you see, this is debit, they have acquired 75, so 25%, that is NCI, of the profit will be attributed to NCI. 25% of this profit for the year, period, not profit on disposal, profit for the period. So if you are taking 25% of that, It is 375. This will go to NCI. Okay, and the balance of the profit and all of the profit on disposal will go to the parent. So this entire profit will go to the parent plus balance of the profit. That is 75% of this will go to parent. So let us calculate. So this is 375 from discontinued operation. So when you go here from discontinued operation, it is 375. Now when you add the total, it's 350. And here to the parent from discontinued operation, you see 375, this 2500 will go with that balance, that is 75% off this plus 2500. The total of this two will go to the parent, that is 3625. So this 3625 will go to the parent profit from discontinuing operation, and then the total. So the total of this two is this two. So if you add this, that is the profit that goes to the parent plus this NCI, this is the total. Okay, exactly this profit that we have started with. So if you have seen that we have finished with entire consolidated statement of profit and loss, with this we have finished working 1, 2, 3, 4, and then 5, 6, and 7. So everything is over. Now we will be moving on to the last question for this lecture, that is activity 3, again a discontinued operation. So now the requirement here is same, prepare consolidated statement of profit and loss. Here also you have two companies, both are subsidiary. Scott is 80% subsidiary, Sky is 90% subsidiary. Now, so these are the two information. On 1st October, Prayer has disposed Scott for cash of 800. Scott's net asset is 700, NCI is 75, goodwill is 10, impaired by 40%. Then Scott's income tax 9,000 under provision. All other items in the statement of profit and loss are deemed to acquire evenly over the year. So it is only with the Scott that is the issue. If you look at the Sky, there has been no disposal, so you can just consolidate line by line. So since I already have the pro forma from my previous question here, and statement of profit and loss also is there, I'm not going to do any changes. I will just change the figure. Okay, so revenue, since I'm disposing Scott, I will only include one subsidiary, that is Sky. Okay, so for this I will not be taking the statement. So I do not need this here because there is not intergroup transactions or any adjustment like this. Straight away I will be just adding the two figures. That's it. So if you see, or rather what I will do is, I will copy paste here. Okay, so now done. So now when I take the revenue, I will take Pero and Sky. Scott, the last column, is not going to be consolidated because you have disposed it. So the revenue would be 665 plus 146. 665 plus 146. 811,000. Okay, then moving on to the cost of sales, it is 285 plus 54. So 285 plus 54 minus 399. So the gross profit would be this minus this, 472,000. Then we will be moving on to operating expenses, which is 150, that is this plus 30. I'm sorry. So 150 plus 30 is 180, and then you have your what? Other operating income. So other operating income is 30 and 4. Okay. Other operating income, which is 30 and 4, 34,000. So goodwill impairment I will not be writing here. So the operating profit would be this minus operating expense plus other operating profit, 326,000. Now this 326 is also your profit before financing and income tax. So from here I'll be deducting I will deduct interest expense. So interest expense is 7 and 8,000. 7 plus 8, which is 15,000. So this I will deduct and get 311,000. Then I will have my income tax, which is 53 and 12. So then I'll get this minus the income tax, which is 246,000. So my profit from continuing operation is 246,000. Then from discontinued operation, what I will get is, I will show in working number 1. Okay, and then profit for the year. Profit for the year, sum of the store. Okay, and then comes attributed to owners and NCI. Okay, so owners and NCI, there's a separate working for it. Then we'll be moving on to the workings. So first working is profit from discontinued operation. Here, working number 4 itself I will show. It's working number 1 for this question. Okay, so first, profit up to the date of disposal. You have to write this. If you see, your year end is, your year starts 1st Jan, and when did you dispose? 1st October. So 9 months. You had it for 9 months. And if you take here, you see the profit of Scott is 85, profit for the year. Okay, with this 85, look at B. The income tax expense includes 9,000 under provision. Okay, so that 9,000 you have to take from the profit. Okay, so 85 plus 9, All the other items in Scott's statement of profit and loss are deemed to occur evenly over the year. Okay. Now, so with this 85, you would be taking this 9,000 provision. And then you will deduct 9. That is that income tax. Why? To find the profit up to the date of disposal. Okay. You know it is for 9 months. But this 85 is profit for the year. But the income tax includes 9,000 under provision of the 2007 expense. So first you have to take it out. How do you take it out? See, in arriving this 85, that 9,000 was included. You have to add back that 9,000. That 9,000 was deducted from here. Then you got this 85. So you add back and then you deduct. And then take the 9 months out of it to get the total profit. It is 9 months of 85 plus 9 minus 9. So 61,500. And then gain on disposal. This gain on disposal is done in working 2, which is here. Okay. So working 2, that is the gain on disposal. So you have sold it for 800,000. Then carrying amount is your goodwill, net asset and NCI. So NCI, they have given you the value already 75,000. And then net asset, they have given you 700,000. There is no profit here that you have to take. Right? You just take the net asset, NCI and goodwill. And then goodwill. So goodwill they told is 100 minus 40% impairment. So goodwill is 60,000. So 685. When you deduct this from here, this is your profit on disposal, 150. And then profit that goes to NCI. This working. So if you see, the profit that goes to NCI, which subsidiary is staying? Sky. Sky's profit is 46, right? So from this 46, Sky's percentage is what? 90. So NCI will be having 10% of this. And this is from discontinuing operation. That is this Scott you have purchased 80. So you will be having 20% of the discontinued profit that you have already got. So here, this is, you'll be taking 10% of 46,000. That is this, the continuing subsidiary. That is easy. Next, from discontinuing, you'll be having 20% of 61,500. Because the profit from discontinued operation is 61,500. That's what we have got here. This one. You see? So that you have to take here for NCI. So here, the total value of NCI is 16,900. Okay. Now, 16,900 is your NCI. So you will go here and put that figure. Here. So here's 16,900. That goes to NCI. Okay. And what is the profit that is remaining here? This is the amount that you have to find out, right? Profit from discontinuing operation. So this one is here, 61,500. Okay, this is 61,500 with this profit on disposal, which is this 115,000. So it's 176,500. This is the total profit. So this 176,500 is from discontinuing operation, that will be written here, 176.5. So this is your total profit. Now when you write to owner, it is this minus this. Sorry. Your profit has to be this, 40 to 500. So here is this minus this. This is the amount that goes to the parent. $405, 600. Okay. So this is the solution for example 9 that we have gone through. You see, the workings that are required here is for goodwill impairment, then profit from discontinuing operation, and then we have got the profit. Then not only that, after profit you have to allocate this profit among the owner and the NCI. But that also two types, profit from continuing versus profit from discontinuing operation. Here also is the same. So these are the workings. Here we had a schedule, and this is the adjustment because we had some intra-group sales that we have deducted here and added in cost of sales. Then we have an unrealized profit calculated in working 2, which we have to deduct from this subsidiary's cost of sales. Why? Because he is the one who has sold to the parent. And then goodwill impairment will write in this subsidiary which is remaining, that is Angus. Okay, and then rest everything is there. So this is the total loss of the subsidiary that NCI will have a share, and this are your consolidated figure. This figures you will put here, exactly the same figure. Okay, so then comes your working number 2. Unrealized profit is easy. You have been given the profit and the percentage of it remaining in the inventory, which is 30%, that is here unrealized. Then we have NCI. This is for profit that goes to NCI working. So this is the loss to subsidiary and take 20%, and then the balance is for the parent. Since you still have the profit, right? It is easy to calculate. Okay, if you see now, working number 4, profit from discontinuing. There are two things here. First, 2 million profit is given from that subsidiary. You only take 9 months because after 9 months you have disposed. That is this 2 million. We have to go back to the question. This 2 million, David, we have disposed entirely. So you have to take it for 9 months. And then when you dispose David, what is that profit? You have to add. This 4,000 will go in your consolidated statement. This 4,000 is this 4,000. This 4,000. Profit from discontinuing operation. Okay. So here, since this is for the period, this 2 million, out of this 25% will go to NCI, which is 375. This is this 375. This 375. Right? And the balance will go, that means the 75% of this 1,500 plus this 2,500 entirely will go to the parent, which is this total. Why this profit on disposal will go to the parent? Because you have disposed entirely. So no NCI. Everything will go to the parent. But here this 75% will go to the parent. So if you add them together, it is 3625, which is this. Which is this 3625 we have been talking about. Okay. Now, when you dispose debit, so this is the consideration. These are the things. The older thing is, with this net asset, you will be adding the profit to disposal, which you have calculated in working 4, and NCI, which you will get in working 7, and then your goodwill calculated in working 6, and you get your profit. So moving to working 6, it's goodwill. Here what do you do? The amount of consideration minus the profit, that is your goodwill cost. Okay, the amount that you have received minus parent's profit on the disposal. When you deduct, that is simply your cost, right? That means you have received 36.5, you have bought it for 25. So this is the profit 11.5. If you find the difference, you're working backwards now. Where profit is given, consideration is given, you have to find the cost. So sale price minus profit is your cost. You understand? That's how you get the cost. So directly they have not given you the cost here. Then NCI is given the fair value, net asset fair value is given, calculate goodwill. Then come NCI. This NCI at acquisition plus, this is the net asset, that is the equity, plus the profit minus the net asset at acquisition. Your post acquisition profit, you take 25%, add it, that's your NCI. That's it. Now moving on to activity 3. This you have disposed, this is there. So you will only consolidate these 2 items. One is 80% subsidiary, this one is 90%. Same question. 2 things. You have disposed for cash 800. Net asset and NCI is given, goodwill is given, goodwill is impaired by 40%. Tax expense is 9,000. Under provision of the 2007 expense in Scots. Okay. So here the only difference is that income tax expense that you have to work out. Rest everything you will consolidate line by line. Only the 2 subsidiaries. That's it. Okay. And the working is for this profit for the period from discontinuing operation. So here, this is the balancing figure. This is the total profit minus this NCI. This you will get, and this is working. We'll see in the working. So here, profit after disposal. Here also you are keeping it for 9 months. This was the profit 85 given here. This 85. This 85,000. With this 85,000, you have to adjust this 9,000. How are you adjusting 9,000? We'll see the notes. This 9,000 first you add back. Why? To find the amount of profit after tax over the year. Then you have deducted 9. Then it is prorated for the period that they were controlled. That means for 9 months. So the 9,000 under provision you will deduct in full. With this profit, you will take gain on disposal, add, and this is your total profit from discontinuing operation. So this gain on disposal 115 we'll see in working number 2 here. Sale consideration, net asset is given, NCI is given, goodwill is 100, take 40% off 60, and this is your gain, which you will add with your this. And working 3 is profit that goes to NCI from continuing and discontinuing. Continuing, subsidiary that is there, 10% of 46. What is his profit? This profit. So you just take 10%. And here you can't take 85%. It's wrong. You can't take 20% of 85. Rather, you have to take his profit. That is not this also, not this discontinuing also, only this. Only profit up to the date of disposal. Not the gain on disposal. Only on 61,500 you can take 20%. So this goes to NCI. Okay, these are some notes given. So this is only for understanding purpose. If you see, when you are consolidating, you are just summing up Pero and Sky. But in your exam question, they will always require some adjustments to be made. This they have kept it simple because their focus is on disposal and discontinued operation. Okay, number two, revenue and cost. You are consolidating up to the date of disposal, that is 9 months. Okay, all are time apportioned except for the under provision of tax. This is a pre-disposal expense. Then NCI will take 20% of Sky's profit for the year continuing and 10% for amount consolidated for discontinuing. Then the gain on disposal will go to the parent, and single amount for discontinuing operation is the sum of 2 and 4. That means this gain on disposal plus this revenue and cost up to the date of disposal. If you add them, that is the single amount that have gone to the discontinued operation. Now, so we are in section D of the syllabus, preparing of financial statements. Here we are asked to prepare consolidated statement of profit and loss. Okay. And we are supposed to account for intragroup transfer of assets and intragroup dividends. Then the effect on the disposal of the parent's investment in a subsidiary in the parent's individual financial statement versus consolidated statements, and also discontinued operation. So now let us summarize the lecture. The statement of profit and loss represents control with income, expense, and OCI. So you will add them line by line for the parent and the subsidiary. Next, an additional section of the statement represents control. So here the profit for the year and the total comprehensive for the year you will allocate among the owners of the parent and NCI. Two things you will allocate: profit and total comprehensive income, TCI, not your OCI, not other comprehensive income. With OCI you will add profit and then also you will allocate between the parent and the NCI. Then the separate statement of profit and loss of the parent will include the dividends that they have received from subsidiary as an income. But in consolidated profit and loss, this is eliminated. Okay, because there you will be having the subsidiary's income and expense consolidated with parent's income and expense. All intragroup revenue expense eliminated on consolidation. Unrealized profit you will add to your cost of sales of the selling company, the one who is selling. Unrealized profit on this is for closing inventory. Unrealized profit on non-current asset transfer you will eliminate from the selling company, and the depreciation adjustment will be made for the buying company. Goodwill impairment loss you will allocate among the parent and the NCI. Both if NCI you are using fair value, and only parent if NCI is measured using proportionate method. If you are acquiring a subsidiary midway, then you have to prorate your income and expense. Okay, because only the post acquisition income and expense of the subsidiary you will consolidate. Consolidated profit and loss will take into account the depreciation adjustment for fair value differences. Then NCI is allocated its share of this adjustment also. Then when you are selling a subsidiary, in the parent separate financial statements you have to calculate a profit and loss on that disposal. And in the consolidated statement of profit and loss, you have to reflect the ownership for that period. and subsidiaries income and expense you will include until the disposal date, and any NCI will have a share in that till the date of disposal. Any disposal of subsidiary will give rise to profit and loss. This you will recognize in the operating category in your consolidated statement of profit and loss. How do you calculate? Difference between your proceed and the carrying amount of the subsidiary in the consolidated financial statements. What is there in that carrying amount? NCI, goodwill, net asset. We have seen that. Then, when you dispose a subsidiary, you can show it as a discontinued operation and present separately from your continuing operation. We have done two questions, right? So these are the two technical articles that you have to read on your ACCA website. Watch your step. The most common consolidation error next is IFRS 5. That is non-current assets held for sale and discontinued operation. Please do read them. Thank you for watching, and I shall see you in the next lecture. So with this, we have finished almost the consolidation part. Major part is over, subsidiary is over. Next lecture is also consolidation, but only a small section. Why? Because from subsidiary we are moving on to associate. Next lecture will be focusing on associate, which we do not consolidate line by line like subsidiary, but a portion, a profit or loss of the subsidiary is included in the income statement. So the next section, the next lecture will be on associates. Companies that we do not control but which we influence. Less than 50% but more than 20%. So let me introduce you associate in the next lecture and stop till here. So thank you for watching.